Now, let's look at the different types of data that we generally refer to when we have to do some kind of calculations for market risk. We say there are various measures for market risk like value at risk, or we talk about expected shortfall. We talk about any other coherent risk measure. So, while computing all these things, we are really looking at some different types of data. What type of data do I need to take? Do I need to take the returns? Do I need to take the profit or loss? How do I really see what are the different forms of data that I have for computation of the various measures of market risk? Now, in that context, I talk about four types of data. We'll try to look at four different types of data. One is called as a profit to loss data. The other is exactly opposite, loss by profit data. So generally the profit by loss is generally represented by P by LT, whereas loss to profit is represented by L by PT, which is nothing but whenever I have to compute the profit at a point T, I am looking at it as the price at point T minus the price at point T minus 1. So whatever is the change in the price plus whatever has been the interim cash flows that came up during the period T. And here we are during the entire between T and T minus 1, whatever has come out as an interim cash flows, that is what we are considering as a part of the profit to loss data. So let's say in the data that I have taken, if you look at it, I have taken the values of Sensex, daily closing values, right from 1st Jan 2014 to 31st December 2014. So these are the values of Sensex. So if I have to go with P by LT computation for this, under the assumption that I am not considering any intermediate cash flow, here it is nothing but the difference, which is the PT minus PT minus 1, the before day's price. So this value comes out to P by LT, which is the profit to loss data. Right here, the profit means a positive value, and if it is coming out to be a negative value, then it means it's a loss compared to the previous day. Now, here if you have to understand the profit, whenever we are using the word profit, it is nothing but it's at a different point. I mean, the prices are at different points in time. This is at time period T, this is at time period T minus 1, which means there is a discrepancy. Generally, whenever we are trying to measure the profit or loss, we are trying to make sure that both of them point out to the same time period. So which means I will either find out the present value of the P by LT or the forward value of the P by LT. Means get both of them to the time period T minus 1, which is the present value part, or take both of them to the time period T. And in doing that, we are using some kind of a discount rate, right? If I assume, let's say, the risk-free rate per year is around 8%, I want to use this as the discount rate, right? So in my example, let's say I want to use the discount rate, let's say as 8%. Then this is per year, but here we are computing as on a daily basis. So the difference is only for one day. So I'll call it as daily discount rate. Probably this I'll divide it by, this is a trading day. So I'll divide this by 250 to very much come out to be my daily discounting rate. Right, so around 0.03% comes out to be my daily discounting rate. Which means from here I can find out the present value of P by LT, or I can find out the future value of P by LT. Either of the ways. So if I have to compute the present value, I am simply looking at the price of the period T. This price, right, the price of this period T, I am discounting it by 1 day. So I am discounting it by 1 trading day, and this, from this I am subtracting the previous price. So that is what it is. Assuming here in our example I did not consider the dt at all, the price at point t, I am discounting it by 1 plus d, whatever is the discounting factor which I have assumed, minus pt minus 1, which is the price at time t minus 1. So there could be a small change in the numbers, right? And this I can take as the time value adjusted number, right? Probably it's better that I do the proper dollarization here in Excel, freeze the location. So I get, okay, minus 37 is becoming minus 43 because I'm discounting the price by 1 plus the daily discount rate. So 0.03% happens to be the daily discount rate from where I am getting the present values of the P by LT. Similarly, I can think of getting the future values also, because both of them need to be at the same point in time. So the time adjusted difference is what I am bringing in by doing either of these exercises. So when I am looking at the forward value, probably the t per whatever is the t minus 1's value, I multiply it by 1 plus d. So from the value at time t, I subtract the value at time t minus 1, which is multiplied by 1 plus d, which is the discounting factor for that time period. So the pt minus 1 plus d times pt minus 1. So this can come out as another mechanism. Right, this can come out as another mechanism using the future. Both of them I am taking them to the time t minus 1. Now if you see the difference, right, between these two methods, whether I do a present value or a future value, if I am doing these two methods and finding out the difference, the differences are very, very negligible. Right, around 0.0, 0.1, very rare. Probably if I am looking at the minimum difference, it is coming out to be around minus 0.2. And if I am looking at the maximum difference in the number, it is coming out to somewhere around 0.17. So it's very, very in a smaller range. Why is it so? The differences are small when the time periods are smaller. In a moment I increase the time period, now instead of daily values, let's say I am taking them for quite a longer period. And otherwise also you try to look at, if I am increasing the discount rate to 15%. Now you see the differences are getting wider. So first of all, as the discount rate is increasing, we see that there is a difference between the present value and the future value approach, right? It increases with the discount rate, and along with that, if the time period is changing, even that would impact the discount rates, right? So that's one thing which we have to understand. And so it all depends on what is the kind of data that I am using for my various calculation purposes. Then similarly, just like the way we have profit to loss data, we also talk about loss to profit data, which is exactly the negative of the profit to loss. Just take the negative. Whether it is the present value or the future value, fair enough. But just we are taking the negative of the same, which means the positive values are becoming losses and the negative values are becoming profits here. If it is a positive value, then it means a loss. If it is a negative value, then it means a profit compared to the previous period. And probably for various risk management mechanisms, this kind of calculation is also more and more appropriate because we try to measure the losses more and all our expressions will be with respect to the loss data. So that's one more aspect. Then we also get into the mechanism of arithmetic returns. The other mechanism that comes into picture is the computation of arithmetic return, which we generally look at it like we are expressing it as a proportion of the previous day's price. The percentage change in price, that is what we are saying. So while we have computed the profit or loss, right, profit or loss kind of a data, we are talking about expressing that same profit or loss data in terms of the previous period's price. And that is what we are calling as the arithmetic return. So again, under the assumption that dt is not existing in this data, it is as good as the price of period t minus the price of period t minus 1 divided by the price of period t minus 1. So this is coming out as the arithmetic return on the data. Right, so these are the arithmetic returns. So same as the P&L, which we have computed, the profit or loss we have computed, and it's the same as that, but the only thing is I have divided that value by the price at the end of the time t minus 1. And here if you remember, if you look at this dt, we are assuming that the d will come at the end of the time period. But generally d may be declared anywhere between t and t minus 1, t minus 1 and t, which means it can very well earn some kind of a return. But this mechanism very clearly assumes that the interim payment dt, no return is earned on it, which means it is received only at the end of the period. And what we are saying is it is not at all appropriate for the longer time periods, because whatever are the intermediate cash flows that come up, we make an assumption that they are reinvested. So generally when we are looking for longer periods of time, right, multiple time periods kind of situation, we do not go with the arithmetic returns. Right, for longer time horizons, we do not depend on arithmetic returns. Rather, we would go with the next approach, which is the geometric returns. But for very small time period, I can very well compute my arithmetic returns. So this is the way of computing the arithmetic returns. And at the same time, I can very well, the other thing which we use in our data is the computation of geometric returns. The geometric return generally represented by capital R, arithmetic return by small r. Geometric return comes out as the logarithm of the previous of the current price along with any dividend that is received during the period divided by pt minus 1. So again, assuming that no intermediate cash flows do come up, here it comes out as logarithm of the current day's price divided by the previous day's price. So this works out, right? This number is coming out as the logarithm and what you could see is very rare that there is a big difference between them. You see, almost all these days the differences are more or less similar, except for one or few days where the percentage is a very minute difference between the two. We see that the geometric returns are more in all the cases geometric returns are similar to that of arithmetic returns, whereas in some cases the geometric returns are slightly lesser than the arithmetic return, but they will never be greater than the arithmetic return. They are assuming that the interim payments are continuously reinvested. That's one major advantage, and which means they are more and more appropriate for the longer time periods also, because they make an assumption that all the intermediate payments that are coming up, they are continuously reinvested. And because the logarithm is defined only for a positive numbers, they really ensure that the asset price can never become negative. Whatever may be the negativity in the return, the asset price that will not become negative at all. Whereas in the arithmetic return case, if the return goes below minus 100%, there is a good chance that the price is going negative, which the Sensex value is going negative, which is not possible in the real world. Whereas the geometric return mechanism, it ensures that the price can never become negative, whatever may be the return. So which means it is more and more appropriate to the modeling of the prices. And at the same time, there are many other advantages. If you look at, okay, the multi-period, multiple days if I am looking at, if I want to find out the average return, right, probably let me just talk about it. The average return during the time period, right, if I am looking at the arithmetic average, so this return, if I am taking the average, right, this returns, if I am taking the average, it is, and you look at a simple, it is as good as, if I am talking of this average, it means that what is the calculation? P2 minus P1 by P1 plus P3 minus P2 by P2. The average is very difficult to compute. It is not the same if I am looking at the last, right? Let me talk about taking from the last minus the first divided by the first. This is 0.30. Whereas if I am adding up, right, let me not take the average, let me take the sum. Sum is giving me 0.27, but if I am actually doing the last minus the first, the percentage change between the last and the first. So during this entire period, if I want to find out the total return, I cannot add up the individual arithmetic returns, because adding up the individual arithmetic returns is giving me 27%. But when I am doing it as a different, as a simple 2 period, taking that entire thing as a single period and finding out the return, it is actually 30.08. But look at the same aspect with respect to geometric return, right? If I try doing the same exercise, okay, logarithm of, let me do it directly from the data, logarithm of the last price to the first day's price. The last day's price divided by the first day's price. Now this is giving me that the return is around 26.29 per 26.3%, and even when I do the summation of the geometric returns here, I am getting it exactly the same, 26.3, which means if there are multiple periods for which I have to compute the geometric return, I can compute the geometric return for each period separately and I can simply sum them up. That's one more advantage that comes through the usage of geometric returns. And mathematically also, okay, let's try to identify the relationship now. Right, let's ignore the D part now. If you look at it, okay, if I am going with the arithmetic return, it is Pt minus 1 by Pt minus 1, which is nothing but Pt by Pt minus 1 minus 1. So 1 plus Rt is Pt by Pt minus 1. Take the logarithm on both sides. Log 1 plus Rt is equal to log Pt by log Pt minus 1, which becomes the capital Rt. Now I can expand the log 1 plus Rt using the logarithm expansion, which is nothing but Rt minus Rt squared by 2 plus Rt cubed by 3, so on. Now what you could see is if Rt is very small, if the Rt, which is the return, is very small, I could clearly see that these two are more or less the same. Otherwise, I see that the capital Rt will be lesser than the small rt. Because if Rt is very small, all these higher power squares and cubes will get ignored and Rt will be lesser equal to Rt. But otherwise, if the arithmetic return is becoming larger and larger, there is a difference between the arithmetic return and the geometric return. So what we have to see is these are the different forms in which my data can be present. I have to be very clear in terms of understanding for the computation of the various measures of market risk, what kind of data is really appropriate and what is the data I'm really going ahead with. So the understanding of the data becomes one interesting aspect in terms of the computations for market risk. All right. Now let's try to understand the estimation of historical simulation VaR, a brief overview of that. Right, value at risk. It's one of the major non-parametric approaches to the estimation of the value at risk. We would like to find out what are the ways in which I can estimate this non-parametric value at risk. Okay, in a very simple understanding to start with. Now that we know that my data could be in the form of profit to loss form or loss to profit form, or it could be in the form of arithmetic return, or it could be in the form of geometric return. So the first two are the absolute, dealing with the profit and loss compared to the previous period. The other two are more associated with the computations of arithmetic return and geometric returns on the data. Now, whenever I am talking about estimating the value at risk using this mechanism, one thing we have to understand, it's very simple because we are depending more on the ordered loss observations. We are trying to arrange the data either in the ascending order or the descending order. Whether we are taking the losses or the arithmetic returns or whatever, we are trying to arrange the data in the ascending or descending, and based on the confidence level and the number of observations that we are looking at, we are directly pulling out the VaR as 1 minus alpha times n plus the 1th highest observation. So I can very well find out. So let's say in our data set, which we have used for understanding the different forms of data, I'll try to find out how many observations are there, which is the n. Right, I want to find out my n, which I'll do using the counting. I'll try to find out how many observations are there. I think 243 observations are there. Now what we simply are saying is, if our confidence interval, so I'll say the confidence level is 95%. I want to find out my 95% value at risk, right? So I will simply find out 1 minus alpha times n plus 1, right? So 1 minus alpha times n plus 1. 1 minus alpha times n plus 1. What is that number? It is 1 minus of alpha is 95% times n plus 1. So because we have so many records, I am really more interested in finding out the 13th observation, or to be more precise, I am more interested in finding out, probably I can always round this off, and I am more interested in finding out the value that is corresponding to my 13th observation. So whichever is the largest 13th, the 13th highest value, once I arrange my data in the ascending or the descending order, that is what will contribute to my 95% confidence level value at risk, right? So probably if I am doing it with respect to the profit to loss data, probably the present value, I will do it let's say on the present value of the profit to loss data. I want to do the same kind of an exercise wherein I want to find out the 13th largest value, right? So I will use a function like Excel. It's as good as arranging the data in an ascending order. I'll take in this, I will try to identify the 13th largest value. So the 13th largest value will give me 342. Within this data set, I am finding out. So here, okay, because I am working on, here I am working on the profit to loss. If I am taking it on a loss to profit, then if I am going with the profit to loss, I am looking at, okay, the smallest, not the largest, I mean 13th largest, the 13th smallest kind of an observation. Or if I am taking the loss to profit ratio instead of profit to loss, if I am taking the loss to profit, I can very well talk about it as the 13th largest. So within this, I am taking the 13th largest, saying 321.94 is the 13th largest loss, which means there are all other losses, there are 5% of the losses which are below 321, and there are 95% of the losses, 5% of the losses are actually above 321.94 and 95% of the losses are below 321.94. So I can say with 95% confidence that my loss will not be more than 321.94. That's the meaning that we are bringing out through this value at risk. I am 95% confident that my loss will not be more than 321.94. So this I am doing it on the loss to profit ratio. But if I have to do the same on the present value of the profit to loss ratio, I'll take the opposite, which means I'll take the minimum, not the maximum. Within this, I'll take the 13th minimum value, which is giving me minus 331. So I am 95% confident that the loss will not be more than 331.63. which means there is only a 5% chance that the loss can be much lesser than this. Obviously, these two numbers came out different because Here I have taken the present value of the profit to loss, whereas this is actual profit to loss, which means here if I had taken simply profit to loss and taken the 13th smallest, I would have got the same thing. Take the 13th smallest, I'll get the same as this. So depending on whether I'm taking a loss to profit or profit to loss, my loss is coming out, my 95% value at risk is coming out in this manner. Similarly, when I do it on arithmetic return, again this I can take the smallest 13th element itself. So within this arithmetic return, if I am looking at the 13th, it's coming out to around minus 1.21%. Means there is a 95% chance that my loss will be more than less than 1.21%, or there is only a 5% chance that my daily loss will exceed 1.21%, going with the arithmetic return computation mechanism. Or when I am going with the geometric return based computation mechanism, again I can very well apply. Within this, I am trying to see the 13th smallest value, which will give me that around again 1.21%, it's set to 2%. So there is a 95% chance that my loss will not be more than 1.22%, going with the geometric return mechanism. So this is what will be given through the historical simulation mechanism. Assume that I am simulating all these stuff. It's simply telling me, assuming that these returns, these prices are the simulated prices, it will tell me that these are the returns that are going to come out. Which means here this is an arithmetic return, which means I could take the price. If I have to take the price corresponding to this, I'll take the price which is of the last period. This is the price of the last period, and I multiply this with this, which will give me that the 95% confidence level for the value at risk using the arithmetic return approach is around 332.30. And because we know that this is a geometric return, which is the logarithm of P2 by P1. So P2 by P1 will become e to the power of this return, right? P2 by P1 is e to the power of this return. So P2 will become P1 times P2 will become, see what I really want is P2 will become, we know that using the geometric mechanism, the return RT is nothing but logarithm of PT by P1, PT minus 1. So PT by PT minus 1 is going to be e power RT, and PT is going to be PT minus 1 times e to the power of RT, right? So based on this, I can find out what could be the loss. What did we do in case of the other? We got that PT minus 1 by PT minus 1. That is the arithmetic return. This we have got it as minus 1.21. So we directly got PT minus 1 as PT minus 1 times minus 1.21. But here it is, first I'll get the PT, which is in this form. Then if I want PT minus 1, which is the difference, PT minus 1 is nothing but PT minus 1 times e power RT minus 1. So that is what will come out to be my VaR. So the 95% confidence interval VaR here is PT minus 1 multiplied by e to the power of R minus 1. So this gives me again 332.30 itself. So I have to be very clear in terms of the computation of VaR with whether I am doing it with the arithmetic return or with the geometric return. right? The computation has to go more from that dimension using the historical simulation method. And apart from that, I can very well go ahead with empirical cumulative frequency function. I can do a frequency, I can do a cumulative frequency for all these things. So the cumulative frequency distribution might come out something like this. Now I'll look out for, let's say I'm looking for a 95% confidence interval. I am cumulative frequency, I am equating it to the confidence interval, map it onto the curve, from there drop it onto the x-axis, and whichever the point here, this is what I am calling as the value at risk. So from the frequency distribution curve, we can very well work out even this aspect. Probably let's try to look at it. Let's say I want to do it for the present value of the profit or loss, right? So I'll try to find out the minimum value of the present value minus 548 and the maximum value of the present value. Maximum value is 640. So what I'll go with is I'll do a simple frequency computation by taking a class interval of, let's say, around I'll take a class interval of let's say around 20, right? I'll take a class interval of, let's say, around 20, and based on that, or probably let me do it for a class interval of 50. That will make things slightly simpler. Okay, I'll take a class interval up to 50. Alright, let me take it until 640. So up to here, let me take the intervals. Then I can very well find out the frequencies associated with each of the classes. Right, so which means I'm selecting all these using the formula of frequency, where my data is the present values and the bins are these particular bins. These are my bins. So I'm trying to find out the frequencies in each, right? So these are the frequencies of each of the groups. Then I can talk about the cumulative frequency of each of the groups, wherein for the first one I am taking it as it is, but from the second one onwards I am accumulating it across. So what I can very well look at is within this interval, right? I am looking at the interval and the cumulative frequency. So what I'll do is I'll do a small plotting between the interval and the cumulative frequency. Let's say I'm doing a small line chart plotting, wherein I don't require this one. So I'm doing a small line chart, and that too with the x-axis values being these intervals. All right. So what I am traditionally getting is a cumulative frequency like this, right? This is a cumulative frequency distribution for the data, right? Either I can even go with on a percentage basis also, if required. Instead of maintaining the cumulative frequency as the number, I'll divide that number, let's say, with the total count. So I'll divide it, let's say, with the total count, so that I can express it in a percentage form. So all these numbers now go towards the percentage computation across. Now this graph is what I would like to plot. Right, I am doing the division of the frequency. No, I have to do it as the cumulative frequency percentage. So I'll do it as the relative cumulative frequency. So wherein I am taking the cumulative frequency and I am dividing it by the total. So this gives my relative cumulative frequency, and probably here what I'll do is, instead of considering the cumulative frequency, I will consider the relative cumulative frequency. Right? Instead of considering the cumulative frequency, I'll consider the relative cumulative frequency, which will give me a kind of graph like this, where the interval is from 0 to 1 here. Now this is like a cumulative frequency function. Now let's say if I am more interested in looking at the value at risk, let's say with 95% confidence interval, what I can very well do is I take the 5% values, which means this graph also I'll edit it just to showcase the 5% scenario. Right, I'll look at the axis, wherein I'll try to work out with the multiple with this vertical axis, where I'll take the major unit not 0.2, but I'll take it as 0.05 to make things easier for us to operate. Now what I'll do is, corresponding this to this 0.05, I'm looking for a 5% significance level or 95% confidence level VaR. Corresponding to this 5, I'll draw a line onto the curve, and from this curve I'll drop a vertical line to this. So somewhere around 300. Right, if I'm drawing a vertical line onto this, the value is somewhere between minus 348 and minus 298. So somewhere around 300. So that's how I can very well compute the 1% VaR or 5% significance level VaR, 95% confidence level VaR, by drawing a horizontal line along the curve from the cumulative frequency axis, where cumulative frequency is same as the confidence interval, and drop a line from that particular point on the curve to the horizontal axis, to the x-axis, which will give me the point of value at risk using the historical simulation mechanism. So we really, it's a very easier way to estimate the value at risk, more straightforward to compute, but of course has a few limitations, but it does not make any assumption regarding the distribution, the shape of the distribution, none of the probability related aspects, none of the parameter computations and all those stuff. Right? All right. Now let's look at the mechanism of understanding the QQ plot, otherwise called as quantile plot, which is nothing but a very important tool if I have to fit a distribution for a particular data. Right? Probably I have a data, I want to really see whether it fits a normal distribution or whether it would fit a log normal distribution or some other distribution. Now, how do I know which distribution is more and more appropriate for the data? Of course, there are many mathematical mechanisms, many calculative statistical tests which talk about the fitment of the data to a particular distribution. Right, but at the same time, a QQ plot gives a kind of a visual representation of the fitment of the data to a particular distribution. Now let's see how we'll understand that. Let's say I have a data, right? The profit loss the company has generated on a daily basis, or the profit or loss with respect to the Sensex on a daily basis. This data has been collected over a period of 1 year. Alright. Now I really want to know whether this profit or loss follows a normal distribution or not. I really want to check, and I want to see how the QQ plot operates in this context. One way, probably if I have to really go with a direct checking of, let's say, the profit or loss or the arithmetic returns or the geometric return, whether they follow a normal distribution or not, I can very well use the skewness and the kurtosis. I see whether these values are very close to 0. Here when I say kurtosis, I mean excess kurtosis. I see whether they are very close to 0, and in that case I may say that the distribution is fairly normal. Right, so probably just to do a few calculations, if I am looking at the mean of this profit or loss, this is this much. Whereas when it comes to the arithmetic return and the geometric return, probably it is, the arithmetic return, the mean is around 0.11%, and even for the geometric return, that's the same case. Okay, and I want to also look at the standard deviation of in all the three cases. So here it's around 195. Extending it, I see that the standard deviations are also more or less same, whether I have computed the arithmetic return or the geometric return. Similarly, when I take the skewness, just to check out the normality, in this case the skewness is 0.02, very close to being 0. Even in the other two cases also they are pretty much closer to zeros. And at the same time, if I am looking at excess kurtosis, I can talk about the kurtosis being 0.48. Okay, not too much away from zeros in all the cases. So on a broader perspective, I may talk about all these three being very much close to normal. But at the same time, what I would also look at is a visual representation. And that is what comes with the QQ plot for me. What I do in a QQ plot is, I try to plot the quantiles. One, about the empirical distribution. For this particular distribution, I will look out for the quantiles. Again, some specified. So I'll check out for the quantiles. One specific to the data, two specific to the distribution. How do I look out? First thing I'll do for the data. So empirical data, if I want to, empirical quantiles, if I really want to find out, the best way is take the rank. I take the rank of this particular entry as a part of the whole in an ascending order. Right, the rank is coming out. Probably it's better that I take it in a number form. So the rank is around 21. And what I simply try doing is this 21, it's like the 21st smallest value. 200 and minus 252 is the 21st smallest value. Here I did not bring in any normal distribution or anything. It's just the empirical data which is giving me that this is the 21st smallest value. Then what is that I am saying? Okay, this 21st smallest value. So I express it as a proportion of total. So which means I'll divide this 21 by the count of this entire list. How many divided by total? So which means it corresponds to the lowest 8.6% of the data. Right? Probably I can say this belongs to the 8.64th quantile. This data, because there are 8.64 percentage of the values which are lesser than this. So this corresponds to 8.64th quantile if I am not assuming any kind of a distribution. But if I am assuming it as a normal distribution, what should be the proportion of this? This is what I compute from a normal distribution. If it is a normal distribution, right? If it is a normal distribution, the area of this particular value, when the mean is around 26.17 and the standard deviation is around 195, and we are looking at it on a cumulative basis, I say that this should correspond to 7.75 percentile of the observations being below this. If it is following a normal distribution, only 7.75 percentage of the elements should be below this minus 252.15. But I am seeing that approximately 8.64% of the values are below this. Now this is what I can traditionally get into the plotting aspect. Right? What I can simply do is I copy these two things. Right? I copy these two things and I can sort them in the form of proportions. I can sort them in the proportions and I take a plot of these two, which means there is one which should correspond to 0.004%, or probably if I am taking it in percentage form. See, the first value should be the 0.41 percentile, but I mean it is actually 0.41 percentile. Whereas when I am looking at it as a normal, the first one should correspond to 0.2 percentile of the data. So this is where I am doing the plotting between these two, which will actually come out as something like this, right? Wherein on the x-axis, now this is what I can think of, the actual normal quantile I can plot on the x-axis. Now instead of this, let me do for a scatter plot. If I am doing for a scatter plot, I can look out for, or even a line chart should be fine. Okay, if I am doing something like this, on the x-axis, I'll take the axis values. I'll take the axis values to be these itself. Right? Or it's better to go with a scatter plot to understand it much more better. Rather than this particular chart, I can even think of a scatter plot wherein I'm trying to take on the y-axis on this, I'm calling it as a QQ plot. On the x-axis, I'll take the normal Qs, and on the y-axis, I'll take I'll take the original. So from here I could see that there is a kind of a curve that is coming up slightly. The more and more it fits a straight line, I can see that it is more and more closely fitting to that distribution. Now this is what we call as a QQ plot. If the QQ plot is more or less linear, I can say that the specified distribution, in this case the normal distribution, fits my data very well. But the more and more this plot is deviating from linearity, I can very well say that my data is having either thinner or fatter tails with respect to the normal distribution, or whatever the distribution I have used for the reference purpose. So there are various other things that we can derive, the intercept and the slope of the linear QQ plot. It gives a rough idea of the location and the scale parameters of the data. And if the empirical distribution is having very heavy tails corresponding to the reference, which means probably for a reference purpose I can have a linear graph also plotted out. On the same I can have a straight line also being plotted out. If at all I am seeing heavier tails, which means deviating much higher or lower corresponding to the reference, then we are talking of steeper slope at the tails. Otherwise, more and more similar slope corresponding to the reference distribution. So it is very important distribution for us to identify the outlier. This is a very important mechanism which helps us. Probably if I had seen a few values somewhere here, a few values somewhere here. So let me just modifying the data a little bit to make things easier for you to understand. Let's say the first one I make it as 30,000 just for the sake. I have made it as 30,000. All the data got changed. Now you look at your QQ plot. In this case, okay, we have actually we have to take the new values, right? Let me take the new values, or if that's the case, I think we should rely on the QQ plot without even doing the transformation. What I'll without even doing the sorting, I can think of using the QQ plot, wherein on the x-axis I'll take this data directly. I'll take this data on the x-axis, and I'll take, without doing the sorting, I'll take this data on the y-axis. Now you see a QQ plot, what change has come out. You could see in the new QQ plot, it is coming very much, it's nowhere close to a straight line. And you see that probably up to here there is some kind of a more or less a fine, but this is looking wide variant. So this is what I typically try to understand as the outliers in my data. Probably if I go back, replacing the value, right? If I go back, replacing the value, I could see that the QQ plot is coming more and more closer to normal itself. Right, I could see that the QQ plot here comes out to more and more closer to normal itself. So this is what can very well be understood from the QQ plots. The more and more outliers can quite comfortably be understood, which really helps us see to what extent the data fits the particular distribution. Because the more and more it fits a particular distribution, I can think of using the properties of that distribution to explain the data quite comfortably. Alright, so we'll use this this fitment of the data to a particular distribution. Probably we can try out 2-3 distributions for this data, and whichever distribution looks very close to normal, we can very well use it as the appropriate distribution for this data, and we can progress further in terms of the next set of calculations. Alright. So that's the reason anywhere I have to understand the pattern of the data, or the distribution, statistical distribution of the data. The visual way of doing that is through the use of QQ plots. All right. Now let's look at understanding the parametric value at risk, which means the word parametric is always associated to a particular statistical distribution. So in a non-parametric way of computing the value at risk, it doesn't really matter to me what is the distribution of the underlying data. Whereas when I bring in the parametric way of estimating the value at risk, the first thing I should be comfortable with is the understanding of the distribution in the data. So the word parameter is always associated with a particular distribution. So I am specifying the statistical distribution from which the data observations are drawn. And probably we can fit in the different kinds of distributions to a data. Check the validity of that fitment using the QQ plot, and or for any other statistical mechanisms. We have various statistical mechanisms which talk about the fitment of the data to a particular distribution. I can really rely on Kolmogorov, Smirnov kind of test, which will talk about the fitment of a data to a particular distribution. But yeah, even without getting into it, the more and more linear the QQ plot is, the better is the fitment of the data to that particular distribution. Now, once I have finalized on a particular distribution and the type of data, here I may look at the profit and loss data, or I may look at arithmetic returns or geometric returns. So depending on what is that I am considering for the computation of the value at risk, along with the distribution associated with it, I should go ahead in terms of computing the value at risk accordingly. So here I would like to look at three different mechanisms or three different versions of computing the value at risk. I'll look at the profit and losses. I assume that they follow a normal distribution, and based on that I'll try to compute the value at risk. I will look at the arithmetic returns. I assume they follow a normal distribution and then try to compute the value at risk. And I look at the geometric returns and I assume that they follow a normal distribution, and from there go ahead in terms of computing the value at risk. So using all these mechanisms, let's try to go ahead. Now let's look at the first one. I want to go ahead with the estimation of the VaR with the normally distributed profits or losses. Now, are the profits and losses normally distributed? One I can use the PQ plot, but otherwise quickly if I have to look at it, better that I check out for the skewness. Okay, I am checking out the skewness of the profit or loss, and I can also look out for the excess kurtosis, which clearly tell us to a large extent it might be normal. So let me make an assumption that it is normal. If that's the case, I also will rely on the mean as well as the standard deviation of them. So the mean is around 26.17 and I know that the standard deviation is somewhere around 195.72. So these are the numbers. Now if I am assuming that the profit or loss is directly normally distributed, the simple way for me to compute, let's say the alpha VaR. Alpha is my significance level or the confidence level. So here I am looking at let's say an alpha of 95%. So let's say I want to find out the 95% value at risk for this particular data. All it takes is minus mean. So I'll take it as minus mean plus Z alpha times sigma P by L. Sigma P by L I know PL, which I know 195. What is this Z alpha? The value that is corresponding. Z alpha is the standard normal variate which is corresponding to alpha. So alpha is for me what? 95%. So the Z95, if I really want to find out what is the value, I can use the standard normal distribution. I know it is 1.645, but if I really want to compute it, the norm inverse, I can very well take the norm as inverse corresponding to the 95 percentile. It gives me 1.645. So from here I can compute the 95% value at risk is nothing but minus mean plus Z alpha times the standard deviation. So this is directly coming out to the 95% value at risk if I am assuming that the profits or losses follow a normal distribution. So it says in this case then there is a 95% chance that my loss will be less than 295 and there is only 5% chance that my loss will be more than 295.76. So this is what is coming out. Z alpha is nothing but the standard normal variate in such a way that alpha of the probability density mass lies to the left. 95% of the mass will lie to the left, only 5% will lie to the right. So that's where I am taking the 95% confidence level. So the 95% confidence level is directly telling me here that 295.76, right? 295.76 is my 95% value at risk going with this mechanism. And in case I am working with a sample, probably mu and sigma will not be known. If that's the case, I'll go with the sample mean and sample standard deviation. That is what I have done here. I don't know the mean of the population. I don't know the standard deviation of the population, but I have computed it by taking the numbers with respect to the sample itself. So that's where we'll get the estimated value of the 95% VaR comes out as the minus mean plus standard deviation times the Z alpha. But if the same way, if I am dealing with LP data instead of PL data, if I am dealing with the LP data is nothing but the negative of the profit data. So if I am using the LP data also, I should get the similar kind of VaR. Now that is what will come out. I will not take the negative there, rest all will be the same. So I'll be taking, if I'm going with the LP data, so for this LP, right, I'll find out the mean, right, I can do this calculation for all of them. So with the LP, this is what is the mean, this is what is the standard deviation. So if I'm going with the LP data here, I'll simply take the 95% VaR is nothing but mean plus standard deviation times Z95, straightforward, which will give me the same. So depending on whether I am dealing with the profit loss data or loss profit data, I have to use the formula appropriately. So if I am going with the profit loss data, I am taking the 95% VaR is nothing but minus mean plus Z alpha times the standard deviation. Whereas if I am going with the LP data, which is normally distributed, I will take it as mean plus Z alpha times the standard deviation. Only for the mean, I will not have the minus sign. If you see here, only the first degree and the third degree, they are changing the sign. But the second and the fourth, they are exactly the same, whether I am taking the PL data or the LP data. So this is how we compute the value at risk when I am dealing with the PL values or the LP values. They follow a normal distribution. Now, the next thing for me is I want to look out for the estimation of the VaR if the arithmetic returns are normally distributed. Now, these are the properties of the arithmetic returns here. This is the mean, this is the standard deviation, this is the skewness, kurtosis. Okay, I can see that very close to 0. So I will assume for the time being, I'll assume that this arithmetic returns, they follow a normal distribution. If that's the case, I want to find out that particular R. The simple way for me to work it out is, I will find out that particular R, right, when I am assuming that the arithmetic returns are normally distributed. I know this is the mean of the arithmetic returns and this is the standard deviation of the arithmetic returns. So I'll try to find out that particular R which exceeds this, right? I mean, see, I'll find out this particular R wherein all the returns that are more than that is equal to the confidence level 95%, which means only 5% of the values are below it. 95% of the values, I'll try to find out this cutoff R, which I call it as R star, where 95% of the values will be above it, right? So this is what I'll try to find out. Now, how do I find out that particular R here, whatever I call it as R star? In this case, how do I find out mean, right? I'll try to find out the mean minus the standard deviation times the Z alpha. Z alpha, I know that this is equivalent to this. So which means mean minus the standard deviation times Z alpha is giving me that the R star is somewhere around minus 1.2%, which is telling me that there is only a 5% chance that the arithmetic return can go below minus 1.2% in a single day. There is a 95% confidence that the arithmetic return on any single day will be greater than minus 1.2%. And what we are simply saying is the 95% confidence interval VaR using the arithmetic return mechanism for me comes out directly. Here we have computed the R star. What I simply do is I'll take the minus of it. If I want the 95% VaR, I'll take the minus of it and I multiply it with the price, the last period's price, PT minus 1, which clearly says that using this mechanism, my 95% VaR, if I am assuming that the arithmetic returns are following a normal distribution, the 95% confidence interval VaR comes out to 328.84, right? Now probably parallelly, if I want to even compute the 99% VaR, how do I do that using the P&L part? For that I require Z99 to start with, just to reiterate the stuff or just to give the practice part. If I want the 99% VaR, I'll first try to find out what is the normal distribution Z value that is corresponding to the 99% area. So it comes out to 2.33. And based on that, I can compute my 99% VaR here as minus mean plus the standard deviation times the Z, 2.32. So works out to 429 through this process. And even here, if I want to do mean plus the standard deviation multiplied by Z99, even this will give me the same. Now what about this one? I require an R star even corresponding to the 99% also, which will give me the mean minus the standard deviation times the Z99. So R star comes out to minus 1.74%. Now this is where I find out my 99% VaR as minus 1.74% multiplied by the previous period's value, which works out to 477. So when I am making my arithmetic return is normally distributed, I am seeing that the 95 and 99% value at risk is slightly higher compared to looking at it on the profit or loss. So that's the second way. Then the third thing which I would like to look at here is the log normal. Here I am assuming that the geometric returns are normally distributed. Okay, geometric returns, this is the skewness, this is the kurtosis. Okay, very close to zeros. Again, I can very well assume that they are normally distributed. Their mean is very close to 0. The standard deviation is around 0.007. Right? And if I really look at it, I could clearly see that if the geometric returns are normally distributed, the price will be log normal distribution. Geometric returns are normally distributed means the price will follow a log normal distribution, because just as a property is any variable x, if I say that it is log normally distributed, then it means I am taking the logarithm of x, it is following a normal distribution. If the logarithm of x follows a normal distribution, I can see that the the x actually follows a log normal distribution. That's a straightforward way. And we have just like a normal distribution, the probability density function. We know for a normal distribution, what is the probability density function? E1 by sigma root 2 pi e to the power of minus half x minus mu by sigma whole square. This is for a normal distribution. But for a log normal distribution, it comes out as 1 by x times, everything remains the same, sigma root 2 pi e to the power of minus half. Instead of x, I take it as log x minus mu by sigma whole square. Everything remains the same. So this becomes the standard, this becomes the probability density function for a log normal distribution. And one more, if I look at the mean of the log normal distribution is nothing but e to the power of mu plus sigma squared by 2. Right, the mean. So if at all I want to find out for this, the mean of the log normal distribution, if I want to find out, it is nothing but e to the power of mu plus sigma squared by 2. So the mean of the log normal distribution here is e to the power of mean plus sigma squared by 2. And I could very well look at the variance of this log normal distribution. It is nothing but mean squared, right? It works out as mean squared into the e to the power of sigma squared minus 1. Right, whatever is the log normal's value, I can very well take mean squared times. So this is the mean squared times, this is the mean. The mean squared times e to the power of sigma squared. So sigma is this one, sigma squared minus 1. So this is working out as, this is the variance that is associated with this log normal distribution. These are the means and the variances that are associated with the log normal distribution. And the median of the log normal distribution comes out as simply e to the power of mu. The median of this log normal distribution comes out to e to the power of mu. So mean is nothing but the median times, now you could see mean is nothing but, you have seen that the median is e to the power of mu and the mean is e to the power of mu plus sigma squared by 2. So I could very well write it as e to the power of mu into e to the power of sigma squared by 2. E to the power of mu is nothing but m, median, m into e to the power of sigma squared by 2 is the mean. So mean is nothing but median times e to the power of sigma squared by 2. Similarly, if I am looking at the variance, if I am looking at e to the power of sigma squared as some omega, I have already defined the variance as mean squared times e to the power of sigma squared minus 1. So e to the power of sigma squared I have already defined as omega. So it's omega minus 1. Mean squared, mean I have already defined as the median times e to the power of sigma squared by 2. This is mean. Mean squared. So this I can very well take it as again mean into e to the power of sigma squared by 2. So it becomes median squared e to the power of sigma squared by 2 is omega times omega minus 1. So this is one more way of defining the variance in terms of the median. And similarly, we will get the skewness, omega plus 2 times omega minus 1 to the power half. So here for me, omega is nothing but e to the power of sigma squared. Similarly, kurtosis. Just to understand how the log normal distribution looks like. But of course, we don't need to get into that aspect. Now let's say if my log normal or geometric returns are normally distributed. So which means my VaR is log normally distributed. If the geometric returns I see that they are normally distributed, I see that the value at risk is log normally distributed. So for which I will try to find some R star, again just like the earlier case. I will find out the R star in this case, again with the same confidence level 95%, 99% kind of stuff. So I will find out, let's say, for the 95%, and I can find out the R star corresponding to the 99% also. So which is nothing but mean minus the standard deviation times the Z95. This is the 95% R star, again close to 1.2% in this case also. Mean minus standard deviation times the Z99, giving me around 1 point or minus 1.74%. Even in case of geometric returns also, the R star is found out in a similar manner. The meaning of R star is I am finding out some cutoff point wherein the confidence level 95% chance of getting a return that is more than that, or 99% chance of getting a return that is more than that. Only 1% chance that the return will fall below that. So that comes out to be my R star, and based on the R star, I can go back in terms of estimating my 99% or 95% value at risk simply by doing this calculation. 1 minus of e to the power of whatever R star we have done. So it comes out as 1 minus of e to the power of whatever the R star that I have got. For 95%, this is the R star. 1 minus of e to the power of R star, that I am multiplying it with the previous price, which is telling me that through this mechanism, the 95% value at risk, through this mechanism, the 95% value at risk is around 327.23, slightly lesser than the assumption of arithmetic returns following a normal distribution. Even in this case, if I have to operate it out, it is nothing but 1 minus of e to the power of R star. This I am multiplying it with the latest price, which is telling me that through this mechanism, it is somewhere around 473. The 99% VaR through this mechanism is around 473, and 95% value at risk is around 327.23. So if you look at it, the normal as well as log normal VaRs, right? This is a normal VaR, this is a log normal VaR for 95 as well as 99 are much the same if we are dealing with the short holding periods. I am looking at it on a single days basis. I see whether it is a 95% VaR or 99% VaR. Between the normal VaR and log normal VaR, they are more or less the same, as long as the return parameters are more or less realistic. If I have much weird numbers, mean being 10%, standard deviations being 50%, which are quite not realistic, in that case there may be a difference. But as long as we are seeing that the returns and the holding periods are more and more realistic in nature, whatever is the mechanism we are using to compute the value at risk, the normal way or using the log normal mechanism, both of them would lead me approximately to the similar result. The big difference will come if the mean and the standard deviations are widely deviating. I could see that in this case, both the cases, the mean and the standard deviation are not that widely deviating. You could see mean and standard deviations are more or less the fine, and that's the reason even our value at risk definition, value at risk computed value also is not much different, significantly different between these two procedures. So that's the way out. First assessing the distribution, and based on the shape of the distribution, we try to compute the value at risk accordingly. All right. Now we will look at what is the way out in terms of estimating a coherent risk measure. Right? Okay, is value at risk typically, is it coherent? I don't think so. Now, when we talk about the coherent risk measure, it should be some value which will be, you see, in terms of value at risk, what is that it is saying? It is telling me a cutoff point. It's only a probability. There is a 5% chance that the loss will be more than this particular amount. It's actually not telling me what is the actual amount that is at risk. If you really look at it, look at the definition of VaR, it is only telling me that there is a 5% chance that the loss is more than something, or there is a 95% confidence that the loss will be lesser than this much, but it's not telling me one single value which is a measure of risk. That's the reason we don't treat value at risk as a coherent measure of risk. Now, if that's the case, what are the other measures which I can use as a coherent risk measures, and how would the knowledge of value at risk help me in terms of working out with this coherent risk measure? Now, this is where I have to talk about the basic simpler form of a coherent risk measure, which is called as expected shortfall. It's a probability weighted average of the various tail losses. Right, I am taking a probability weighted average of the various tail losses, which means I can very well do an average of the different tail value at risk, which is, now in this example, let's say I want to find out with respect to the tail. Let's say I'll talk about 95%, 95.5%. Like this, let me go up to 99.5%. Right, 98.5, 99, 99.5%. Let's say for this various scenarios, I will find out the VaR. Right, I will find out the value at risk in each of these scenarios. For that, what is that I require? I first require the Z alpha. Right, the Z alpha is what I require in each of these cases, which typically comes out as the norm S inverse associated with this particular probability level. Okay, this is the Z alpha, and in this case I also require the mean and the standard deviation as well. So this is my mean value, this is my standard deviation value. Right, now how is that I can compute the 95% VaR here? Okay, then standard deviation, I'll take it with respect to the profit and loss. The standard deviation, I take it with respect to this profit and loss, so 195. So based on that, I can compute the 95% VaR, 95.5% VaR. So I'll try to compute the VaRs associated with each of these periods. So what is that? I can take them as minus mu plus the standard deviation times Z alpha. So minus mu plus standard deviation times Z alpha, giving me that the VaR is 295. Like that across, if I am computing the VaRs for 95.5, 96, 99, 99.5, all finally I am trying to compute is the expected shortfall. The expected shortfall here is nothing but I can take it as a simple average of all these tail value at risk. So the expected shortfall is coming out to 362.72. So I can estimate the expected shortfall as an average of the various tail value at risk. So I'll compute the value at risk for each of the periods, and I am finding out the simple average of the same. So which means I am slicing the tail into a large number of slices, right? So here I have sliced them into 10 parts. Each slice having the same probability mass. So 0.5, 0.5, 0.5 is what is the slicing that I have done. And I am estimating the VaR that is associated with each of the slice. And then I have taken the expected shortfall as the average of all these. Now let's say if my slices, now in this case let's say my slices are just 0.25%. Right, let's say my slices are to the extent of not 0.5 but 0.25%, which means probably I can very well express them as something like this. From 95 I am taking up to 99.75. So here what is that I am going to get? Minus mean plus standard deviation times Z alpha. How am I getting my Z alpha? I am getting it as norms inverse associated with this particular number, which works out that for 95% this is the VaR and so on. Now my slices got improved, and from here if I am finding out my expected shortfall through this mechanism, right, if I am finding out my expected shortfall through this mechanism, I am taking it as average of all these numbers, resulting in 369. So what is coming out is a larger value of n. More and more slices that I am doing, I'll get much more accurate results. So this number will keep increasing. Now if I do it with a difference of 0.1, which means the slices are almost 50 slices. If I can do it with 0.01, I have 500 slices. Now depending on the larger number of slices, I get more and more closer to the accurate result. Now what it is doing, right, now if I am looking at this entire thing being my loss distribution, right, the loss in the particular area in the tail, it is giving for each quantile there is an equal weightage that is being given, and for this entire area the weightage is going to be 0. That is what if you are looking at all the tail loss quantiles, these are the tail loss quantiles. They are given equal weight, and all other quantiles are getting a weightage of 0. That is what is going as a computation of the expected shortfall. So this is a way out I can use the expected shortfall computation. This is one form of coherent risk measure. So it is giving me a dollar term. This is the amount that is the expected loss. Now similarly, I can use a very general form of other coherent risk measures. So instead of taking a blind average of all these things, they talk about giving different kinds of weighted averages. Instead of directly going with a plain average of all these things, there is a mention about coming out with a different weighted average to the different quantiles of the loss distribution. Now if I am assuming that the loss distribution is something, I divide this loss distribution into different quantiles. Right, I divide this loss distribution into different quantiles. I find out the value for each of them, multiply it with their corresponding probability, just like this. Right, as here I have given the value at risk equally for all. Rather than that, I can give different weightage to each, not only for up to 95, probably up to 90, 80, 20, for all the possibilities I can give different weightages, or I can go with a very generic loss distribution function. The weighted average can be defined through a function. Let's say if I am going with an exponential weighted weighing kind of a function, I'll use this kind of a mechanism to provide exponential weightage to each of the slices. Right? Probably if you see like this, let's say I have different slices n. The whole space I divide it into 10 slices. So what are the numbers? 10%, 20%. I can go, let's say, up to 100%. These are the slices. Now corresponding to each of the slice, I can very well compute my value at risk, right? And at the same time, I can find out the weightage. Just like the way we have done even in this, for only the tail we have found out here, rather than that across I am trying to find out here. Now what I'll do, I'll find out the value at risk corresponding to each of these quantiles. Why only 95%? I would like to find out for each, which becomes minus mean plus the standard deviation times the norms inverse associated with this particular distribution. So here the value at risk are coming out to be something around this. Okay, let me not consider the 100% part, right? Probably I can do the same for 0%. Even for 0 it does not work. So probably from 10 to 90, let's say I'll do the slicing of each one of them. Then at the same time I can go ahead, and so these are the slices, and corresponding to each of the slice, these are the value at risk. Now I'll give a weightage. I go with this formula for giving the weightage. Phi r e to the power of minus of 1 minus p by gamma divided by gamma times 1 minus e to the power of minus 1 by gamma. So the corresponding to this, I'll compute the weightage. So probably depending on the risk attitude, let's say I take gamma is 0.05. So corresponding to this, let's say I'll give the weights. What is the weightage for me? E to the power of minus of 1 minus p by gamma minus of 1 minus p by gamma. So this is the numerator. Denominator is gamma times 1 minus of e to the power of minus 1 by gamma. So gamma times 1 minus of e to the power of minus 1 by gamma. Okay, so the weightage for this is going to be very small, and as it moves, the weightages for each of them are going to come out to this much. So weightages for each of them, if I am going with that kind of a mechanism, the weightages to each of them is coming out going with this kind of an exponential distribution approach. So these are the, instead of giving equal weights to all these VaRs, I am giving the weights based on some exponential distribution. And based on this, I can very well find out the weighted VaR. Right, I'll find out the weighted VaR by multiplying the VaR with the corresponding weightage. So these are the different values that are working out. It's better that I look at in terms of the decimal. So finally, I'll get, so these are the numbers that are working out, which means I can very well get my coherent risk measure. Through this mechanism, I am getting my coherent risk mechanism risk measure as the summation of all these weighted giving me for this case the coherent risk measure is around 662.75. Instead of going, see, that is what is a simpler way for me to work out. Instead of going with a simple assumption where I'll give zero weightage to the entire loss data except for below the tail, rest all will carry a zero weightage. But here we are looking at giving a different weightage based on some weighted function. We are giving a different weightage to each of the VARs, and that is finally resulting into the coherent risk measure computation based on the exponential weightages that you have provided towards each of them. Right, I have to take the average of all of them. So I can compute the average of all these numbers, which can give me that the coherent risk measure is going to be 73. Now the same logic, I can increase the number of n. Increase the number of slices. This is a very small number of slices. Probably just to give you the scenario itself, if I'm going with, let's say, for every 1% I'm doing the slicing, 1%, 2%, as I am increasing the number of slices, let's say, let me go up to 99, which I can do it even with a 0.5 and different. And for each one, I am computing the VAR, which comes out as minus mean plus the standard deviation times the Z, which comes out through my norms inverse associated with this 1%. So these are the different VARs that are coming out. And if I am going with the weights corresponding to each one, I'll use this exponential function e to the power of minus, right, e to the power of minus of 1 minus p e to the power of minus of 1 minus p divided by gamma. Let me take it with 0.05. So here let me even make an assumption regarding the gamma for us to understand. Let's say based on the risk appetite, I am setting the gamma to around 0.05. Which means I am taking it as e to the power of minus of 1 minus p divided by gamma. This is the numerator, divided by gamma times 1 minus e to the power of minus 1 by gamma. Now, if I look at this whole thing, so the weightage here is coming out to be this much, and across these are the weights. Now, based on that, I'll get the weighted VAR, which simply comes out as the multiplication of the VAR with the corresponding weightage. Across these are the numbers. And probably it's better that I compute. And based on this, if I want to compute the coherent risk measure, it is coming out as the average of all of them, which is working out as 286. Now what we are observing here is the more and more I am increasing, right? Now if my risk appetite becomes 0.1, then which is an indication that my risk taking levels are improved. If my risk taking levels are increased, I see that the 95% or the coherent risk measure associated with VAR is 243 here. So gamma is playing a role. And apart from that, if I'm looking at if it is only 0.05, the coherent risk measure is coming out to 286. If the n is becoming larger and larger, the more and more accurate results are coming out through the coherent risk measure also. So we keep increasing it. So probably yes, now I have done it with 100 slices. What I'll do the exercise with 200. So I'll try to find out what is the coherent risk measure I got with 100, how much I am getting with 200. Now the moment I'll see what is the change. So I keep on doing in such a way that the change comes down and down and down. I said that is what I am calling it as an error. Whatever is the value that I am getting, risk measure value that I am getting by taking n versus taking n by 2. Based on these two, I am finally arriving at my coherent risk measure, seeing whatever is error. I am keeping on doubling the n to see that the error is coming down. I'll set a tolerance level for this error, and that is where I'm stopping the doubling process and finally boiling down that this is the value that is associated with my coherent risk measure. So we can very well write a few routines to automate this process, but understanding the traditional coherent risk measure where the weights are determined by some function. The expected shortfall is a special form of this coherent risk measure where only corresponding to the tail there are equal weights that are being given, and anything outside this, above this, which is not in the tail, there is a zero weightage that has been assigned. So that's what is happening in case of expected shortfall, but this is much more generic. I can very well define the weighting function corresponding to each of these quantiles. So that's the way out computing or estimating the coherent risk measure. So the most important thing, I should be able to find out the quantiles. I should be able to compute the VaRs associated with each of the quantiles. So I should have a VaR engine which will compute the VaRs for each of the quantiles. So I am doing small adjustments to that VaR computations by providing an appropriate weighting function, weightage function, which is helping me to arrive at coherent risk measures, which means any firm which has already been very extensively using value at risk, it can quite comfortably shift towards a sophisticated coherent risk measure. The costs that are associated with it are much lower. But whether it is expected shortfall or any other coherent risk measure, what we are very clearly seeing is these directly give one single number that is associated with, right? These give one single number that is associated with the measure of risk, and that's the reason we are calling them as more and more coherent compared to the VaR, value at risk. All right. Now let's try to understand the standard errors that are existing in the various risk measures. Let's all try to understand all the different risk measures that we have computed are based on the sample, some distribution which we have assumed about that particular data, and based on the sample we have computed the mean and the standard deviation, etc., and then computed the VaR. Now if all these are sample specific and they have some kind of variation in the values, which means the value at risk is also volatile, value at risk also follows some form of a distribution. Now that is where I am more interested in finding out the interval that is associated with the value at risk. So which means value at risk is also not a fixed value. It is basically an interval. So I will try to find out the 90% confidence interval or 95% confidence interval associated with the value at risk, or for that matter any other measure also. So even with the coherent risk measures, the same thing is going to happen. Now how do we really look at that? The reason why we understand the standard error in the various risk measure estimation is to identify their precision. how much accurate they are, because if they are measured imprecisely, probably that estimator is of no use. There is no point in looking at the value at risk if the measure of that value at risk is very imprecise. So that is the reason we are trying to go ahead with some kind of mechanisms in terms of computing the standard errors of the various estimators. So either a quantile estimator like value at risk, I want to see what is that I can do in terms of finding out the quantile estimator, or in terms of finding out the range for value at risk. And I would also try to find out this estimator standard error for the estimator associated with the coherent risk measures like expected shortfall and others also. Now, when it comes to this quantile estimator like value at risk, right? If I am assuming that Q is the value at risk, some percentile, let's say 95% confidence value at risk. Now, depending on the sample that I am choosing, the value at risk is going to change. So this is where I am trying to find out what is the range in which the value at risk is going to vary. So what is the 90% confidence interval range or 95% confidence interval range for this particular measure Q? Now that is what we are looking at. Probably for that, a simple logic that came out is, let's try to assume that f of x is the cumulative distribution function of a particular data. Small f of x is the probability density function, which actually comes out as the derivative of this cumulative distribution function. And let me choose a distribution in such a way. Right now, let's say I am talking about the estimation of some Q, and I will choose a bin size. There is a bin, I am creating a bin, I am dividing the whole data into quantiles. Now let's say I want to do for this particular quantile Q, which is a 95%. So I want to design a small bin, which is a small interval around it. Now let's say I am talking about a bin of size h. Then I look at it as Q minus h by 2, and this is Q plus h by 2. Right? I will assume that there are k minus 1 observations which are below Q minus h by 2. There is one observation that is lying between Q plus or minus h by 2 and n minus k observations that are greater than Q plus h by 2. Now I can very well see that this probability is, what is it proportional to? What is the probability of finding Q minus k minus 1 observations below Q minus h by 2? It's basically the distribution function up to x lesser than this. So this I am putting it to the power k minus 1. Observing one value between Q plus or minus h by 2 is the probability is the density function, and then I have it as 1 minus f of x, which is greater than Q plus h by 2. I am looking at it as n minus k. Now this we are simply calling as, probably if I am looking at these two combined together, I am looking at it as k out of n observations which are below this particular value, and 1 minus k by n proportion of the observations which are above that particular value. So we can very well look at this being the probability P. What is the proportion of values that are much below and the proportion of values that are much above? So based on that, That is what is coming out to be the P, the proportion of values that are much below very lower proportions and very higher proportions, which means we are talking about the tails, where the proportions are much lower or proportions are much higher. So then we are what is coming out is, once I go ahead and do the derivation of this result, what comes out is the variance of Q directly can be found out using P into 1 minus P divided by N into F of Q whole square. The simple way we will try to operate that out. Let me take an example that will simplify the process for us. Here I will find out the 95% VaR. We know the basic things that are required for the computation of the VaRs. This is the mean, right? Let's say this time I want to do it on any of those, or probably let me do it with this profit or loss itself. This is the mean, this is the standard deviation, right? These two numbers I do have, the mean and the standard deviation. So based on this I can find out the 95% confidence VaR, which comes out as minus mean plus the standard deviation times the 95%, the norms inverse associated with 95%. So the 95% confidence interval VaR is 295. Now what we are saying is, this is not a fixed value. There is an interval around it. And that interval, I am trying to look at it as P into 1 minus P divided by N into F of Q whole square. Now, N into F of Q whole square. Now for that, what is that? I will design one bin. What is that bin size? Okay, I want to design a bin with a value of plus or minus 5. So which means, based on this bin size of 5, I'll get my lower interval. I'll get this lower interval as the VaR value minus H by 2, which is 293.26, and I'll also get upper interval as the VaR value plus the bin size by 2. Now I want to find out what is the probability of the P&L being lesser than 200 and P&L being lesser than the lower interval. What is the probability that if it is following a normal distribution, what is the probability that P&L is lesser than 293.26? So I can very well find out what is the probability that P&L value is lesser than the lower limit, right? Which means I'll do a norm distribution where I'll look out for 293 with a mean of 26 and a standard deviation of 195 on a cumulative basis. So the probability that the P&L is lesser than L, right, lesser than the lower limit, is around 0.91. Similarly, I want to find out the probability that it is, I will also find the probability that it is greater than U based on the bin size. So again I am going with the norm dist. So this is giving me lesser than 298. So 1 minus of this will give me the probability of greater than 298. So this with a mean and a standard deviation, 1. So this is around 0.08. So the probability of lying between the two, the probability of L lying between the Q lying between L and U, the probability of Q lying between L and Q, that is what actually is my F of Q, right? The probability of Q lying between L and Q, which comes out as F of Q, which directly comes out as the difference between these, which is around 0.003. So in this case, my f of q comes out to be 0.003, right? Then, so this is working out to f of q. Now from here, I am also looking at the p. The p is nothing but the tail part. So what is either greater than u? What is the tail? That the loss is more than 298. So that will come out to be my p. So I'll take this as the p. So the tail part is what I'm looking at. So this is what is my p. This is what is f of q. And based on this n, which is the sample size, I can do the counting on what sample size this number is arrived at. So based on a sample size of 243, I got this number. So based on this, I can very well compute the variance that is associated with Q. Approximately it is equal to P times 1 minus P divided by n times f of q square. N times f of q times f of q. N times f of q square. So the variance of q is somewhere around 19.93. And from here I can very well find out the standard deviation of q. The standard deviation of q will come out as the square root of the variance, around 4.46. And based on this, I can say the 90% or 95% confidence interval is directly coming out as whatever is the estimate that I have got. My 95% VaR is 295 minus 1.96 times, or probably how did I get this 1.96? I'm going with a 95 or 97.5%, right? So I'm going with a norms inverse of 97.5%, 97.5% times the standard deviation, which is this one. So 287.01, and this on the higher side, I'm taking this equivalent to plus. So it is very much working out to the 95% confidence interval for the value at risk in this example is anywhere between 287.01 and 304.51. Now, if I am changing the bin size here, let's say instead of 5, I'll choose the bin size. I am getting a very narrow interval, 291 to 300, which means my interval is changing based on the bin size that I am going with. That's where a slight drawback comes into picture. If I am choosing a bin size of 1, it is saying that the 95% confidence interval for the VaR is around 251 to 339. So the bin size is actually creating a difference in the choice in the interval that is estimated for our VaR estimator. So here if you are seeing, okay, what are the various inputs? Now if I am looking at P, the higher is the P value, right? If it is for a 95% VaR, this is what is working out in this way. But if I am looking at a 99% VaR, you look at it, the 99% VaR is 429. The P is going much lesser here. So the higher the values of P, now if P is going lesser, what is happening to the variance here? The variance in this case is 1321. Right, because f of q has gone quite drastically lesser. Now let me go back. In 95% case, the variance of q is 507. But in a 90, now there the f of q was 0.0007. But if I am going with a 99% case, my f of q has gone drastically lesser, p has gone even lesser. But overall, I see that the variance has gone much higher. So mathematics wise, depending on if p has gone lower, the numerator, see depending on where it is, if p is high, 1 minus p is also good enough. So in the tails, p and 1 minus p, if they are more and more towards the tails, I could see that this number, now if you see, if p is 0.5, 1 minus p is 0.5, the value is p is 0.5, 1 minus p is also 0.5. So it comes out like numerator is coming out to 0.5 squared. But if p is 0.01, 1 minus p is 0.99, overall it is coming out to 0.009. The numerator is coming out to be much lesser. So what you could very clearly see is, depending on the p, your numerator is changing accordingly. So what you could clearly see is the standard error falls as the sample size n is increasing, and at the same time, as the probabilities become more and more extreme, the standard error is increasing. So more extreme the quantile, the less precise is the estimator. And the choice of the density function, depending on f of q, the h which we are typically using, the bin size, that is making a difference to our estimate. The more and more wider the bin we are selecting, as we could see in our example, the more and more wider. Now here the confidence interval is 251 to 339. But if I have taken the bin to be much wider, I am receiving a very narrower interval. Intervals can be wide and they can be sensitive to the arbitrary choice of the bin width. But at the same time, they are easy to implement. With large sample sizes, they are much better to implement. But there is a possibility that they can produce wider confidence intervals. In that case, the estimator does not make any kind of a sense. So we really need to be careful while looking at measuring the standard deviations or standard errors that are present as a part of the estimators. And in some cases with coherent risk measures, the major mechanism that is suggested is going for a bootstrap and create a kind of a simulation. Right, to come out with large number of estimators. Now I know that P and L, let's say, follows a normal distribution. Now if P and L follows a normal distribution with mean this much and standard deviation this much, I can generate different possible values which are sticking to that same. Now probably it's as good as, okay, I'll generate the values back, right? Let me say I'll generate the norm inverse by going with some kind of probability, which is, let's say, a random probability with a mean equivalent to 26 and a standard deviation equal to 195. Now using this, let's say I'm generating different possible values. So I'm generating a different scenario altogether. These are the different possible values that are associated with the P&L, which approximately follow the same kind of mean and the same standard deviation. Instead of very few, I'll generate some thousands. Right? That is what we do as a part of the simulation exercise. So instead of this very few, I am generating some thousands of values which traditionally follow that kind of a mean and that kind of a standard deviation and more or less are normal in nature. Now if you look at the mean and the standard deviation, just to see, the mean for this data is almost closer, and the standard deviation of this data also should be very much 22 and 198, more or less it comes similar to this data and everything follows a normal distribution. Now what we are simply saying is, using this particular data, now that I know the VaR, I compute the different coherent risk measures by following an appropriate weightage function, by computing the different value at risk. I'll try to finally come out with a coherent risk measure. Now this keeps on changing. So which means I am getting a different coherent risk measures out of that each of the different samples that are getting generated. Now the coherent risk measures, I'll generate some thousands of such, and based on that I can look out what is the 95% confidence interval range in which those measures are lying, 90% range in which those measures are lying, which is more like a simulation kind of a mechanism rather than any kind of a closed formula that is being used for the same. So that is how we try to measure the variance or the standard errors that are associated with each of the measures, and based on them try computing the 95% confidence intervals or 99% confidence intervals associated with each of these estimators as well. All right.